All right, hello everyone. Thank you for coming out to tonight's event, which I think will be a great little panel. My name is Mohammed Abdelmalik, and I'm a junior in SEAS, the School of Engineering and Applied Science, and also an executive board member in CORE, the Columbia Organization of Rising Entrepreneurs. My interest in blockchain actually started in 2011 when I first got introduced to Bitcoin via Bitcoin mining, and I've just been interested in the space ever since. About a year ago, with the help of Joe Lubin, the co-founder of Ethereum, I actually started the Columbia Blockchain Lab here, which is now called Blockchain at Columbia, and is the place on campus for education on the blockchain space. Since then, I've been working on a nonprofit called the Distributed Foundation, working on the Distributed Knowledge Project to bring blockchain education to the masses. And our moderator here is Nat Kellner. He's the Columbia Entrepreneurship's Associate Director, specializing in new projects. He drove the successful launch of the Columbia Startup Lab, the relaunch of Columbia Bartending Agency, and most recently launched the Columbia Entrepreneurship Blockchain Studio. Nat plays a key role on the teaching team of Steve Blink's Lean Launchpad, launching new ventures, the Greenhouse Accelerator at the Columbia Business School, and Hacking for Defense in the Computer Science Department. Nat also conducts entrepreneurship office hours and works as a successful launch on Columbia Entrepreneurship's Next Big Things. Prior to Columbia, Nat also co-founded the Vermont Venture Foundry. And with that, I'll just hand it over for this amazing panel. Go for it, Nat.
Thanks for the introduction, Mohammed. So, welcome to our panel on blockchain. Hope you guys are having a great afternoon. Rather than me perhaps butcher our great guests' bios, I'm going to let them introduce themselves. So, Joel, why don't you start and let's work down the panel.
Thank you. My name is Joel Monegro. I'm a partner at a new venture capital firm called Placeholder. We couldn't come up with a name, so our lawyers did. And it's a venture capital firm based here in New York City, and we invest exclusively in crypto networks and crypto assets. So it's companies that are launching new kinds of services that use the same decentralized architecture that underpins Bitcoin and Ethereum, but applied to other kinds of services.
Hi, I'm Brittany Laughlin. I'm a partner at Lattice Ventures. We're an early stage venture capital firm here in New York. We focus on helping entrepreneurs start their businesses. We've recently made a number of blockchain investments, and we're active in this space, but we also have investments outside of blockchain, looking for network effects across different businesses.
Hi, everyone. My name is Wendy Shao Shattuck. I work at North Zone Ventures. We're a venture capital firm that's been around for more than 21 years between Europe and here in the US. Our best investment to date has been Spotify, which just had their IPO recently. I lead our blockchain investment thesis, and before that, I was a Columbia grad from the business school.
Let's have a quick round of applause for our great guests. Yeah, thanks. So we know this topic can seem a little esoteric, and not everyone sort of understands the plumbing. And so just to begin, to ground the conversation, I've asked Joel to give his sort of elevator pitch on what blockchain is, and maybe we'll have some shared definitions after that. And then we're just going to dive into some great topics. So Joel, why don't you go ahead?
Sure. So it's a very complex kind of architecture and structure. A blockchain is, one way to describe it is it's a decentralized database. It's been called a decentralized ledger, and all of those things are involved in very complex math and cryptography and networking components that are very technical. But the most important thing to understand about blockchain and what it does and what's different about it from everything else that we've had in the past is that blockchains as a kind of database allow us to create digital scarcity. And that's really important because up until now, whenever we digitize something, say a document, we turned it into a PDF, there was no way to ensure that there's only one copy of that PDF that one person has. Because if I send you a PDF over email, I've sent you a copy of that file, and I retain a copy of that file. What Bitcoin really introduced that was novel to the world was the ability to create something that's digital, a Bitcoin, that you can provably ensure that there is a single one of those in the world. So there's 21 million Bitcoin that will ever be created, and once we get to that point, the blockchain allows us to trust that there will only be 21 million Bitcoin and not anymore. And what that enables us to do, one step further, is to create really programmable money or programmable assets. And that opens a whole world of possibility, because in the past, assets tied to the real world, they're really rooted in our physical reality. And they're scarce, and because they're scarce, they're valuable. So gold is valuable because there's a limited amount of gold. It's really difficult to create value that only exists within the digital realm if you don't have a way to make a digital asset scarce, and that's what a blockchain allows us to do. And the way that a blockchain allows us to do that is by replicating the ledger, the database that keeps track of who owns what across thousands and thousands or hundreds of thousands of computers around the world. And that makes it such that every person who plugs their computer into a blockchain is able to see the balance and the holdings of every person in that network, which allows the entire network to make sure that not more of the asset is created over time. And the really beautiful thing, going back to the digital scarcity point, is that we can program these things. Now that we can create assets that are digital and provably scarce, they're also programmable. And that allows us to build the kinds of networks that we're building today with things like Bitcoin and Ethereum and Filecoin and so on.
Great, thank you. So that's a little bit of the what, and I think we could spend days talking about how and really digging into the machinery of it. I don't think that's the right use of our time here. What I'm interested in is why. You guys put a lot of effort and time into working in this field, becoming experts. It's somewhat controversial and niche. And the people I talk to, they all have sort of a eureka moment or like a light bulb moment with it. So maybe it'd be illustrated for you, Wendy or Brittany, share like what was that moment like and why are you really passionate about this space?
Yeah, I think one of the first things that became very clear when I started talking to people in the space earlier on, and actually Joel was one of them, was that now you get to have a blank playing field with recreating different markets of goods and services being exchanged, but setting forth a set of rules that everyone has to abide by. And those rules can sort of be defined outset, and without sort of anyone having the ability to change those rules, see what happens with the economic system. And what's kind of happened since with a lot of these networks and sets of rules is that there is this early sort of anticipatory value, speculative value, if you will, that gets created that helps people come together on the supply side and supply really valuable goods and services. And then over time, a whole new way of distributing value gets created in a market. And I think that's pretty revolutionary if you think about it, because traditionally you have sort of people who create the goods, who sell them, and then they take a margin on that. And that whole thing gets disrupted by a blockchain model. I'm being kind of vague here, but I'll just bring it down sort of to earth for a second. Imagine a social media kind of database / network where when you add value to it by posting content or creating content or curating it, you earn back in tokens the value that you create. And then an advertiser wants to buy the attention you've generated in this network. They buy the tokens to advertise, to push their content up to the front. So it's a fully self-sustaining ecosystem or business network that doesn't require a middleman to dictate the rules, because that's kind of defined up front by the community. And so that's kind of the exciting part to me, the different behaviors that incentivizes people to experiment with in real time. And to many, I think this is sort of like behavioral economic experiments happening in real time, accelerated with real money, some of these projects.
Yeah, I guess just adding to that, so Joel and I actually worked together at Union Square Ventures, and the first day we saw a bunch of blockchain projects. I think we saw 7 one day. One of those was Coinbase, so we decided to invest in Coinbase as an early investor, USV. But I think these 6 other projects were kind of crypto anarchists as part of it. So people thinking about, well, we don't like the way that the internet is being ruled, so we want to create this alternative way that we can create an ecosystem. And it really got me thinking about the empowering the edges, like where are there people who can't do what they want to do because there's gatekeepers online who prevent them from doing that. It may not be as directly personally relevant in the developed world, but in the developing world, if you don't have identity, or you can't leave your country, or you can't bank because of who you are or what gender you are or what age you are, those types of keys are actually unlocked by using the internet as a medium for that. And blockchain creates a lot of opportunity to create new ecosystems and new ideas that don't have to fit into existing standards. So I think that kind of empowerment of the edges, we see it economically, we see it in terms of the technology, and that's like a really exciting space to just think about what can come out of this when there are no rules of how you can kind of engage with the internet.
Great, thank you. So hopefully everyone's familiar with what Bitcoin is and at least like heard of it, internet money. And it's powered by something called the blockchain. And you know, something that our panelists have been alluding to is that the blockchain can do so much more than just be money, right? And so I'm curious, what are some interesting projects you've seen which maybe demonstrate how a blockchain can be used beyond just being Bitcoin, digital gold, stuff like that?
Well, a really good example is actually something we were talking about just before coming up on stage, which is a network called Decentraland. And what it does is it's creating this virtual world. Some of you may know about a game called Second Life that existed for a while or has been around for a while, where it's this sort of trying to create a virtual world that mimics the real world. Decentraland is doing that, except that they're using blockchains to create scarcity in the land. And going back to what blockchains allow us to do, they allow us to create these assets that are digitally scarce and programmable. What they've created is a network and a protocol where once you enter this virtual world, the land is provably scarce. And what that means is that now that land can have value just as land can have value in the real world because it is scarce. And so that is one example of what the creative things that we can do with this technology. And what's interesting about Decentraland is that all they need to do is create the platform and create the economics or the economic incentives for people to go and speculate on this virtual land and actually build VR worlds, virtual reality worlds in this virtual world. And over time, hopefully what we'll see is a lot of creativity and a big network of people creating and participating in this world, kind of similar to a movie some of you may have seen called Ready Player One, where everyone sort of lives inside this reality. What's different, however, is that in the movie Ready Player One, that virtual world, which is called Oasis, is controlled by a single company, and that's kind of part of the problem. But with Decentraland, because it's built with a blockchain, there isn't a single company that's in control of the entire world, but rather the people and the community who make part and who build this digital reality are the ones who are empowered to control it and change it and evolve it over time.
Any other examples?
Yeah, I think this notion of how do you have ownership because of the scarcity, like how can you contribute assets that you have, or how can you earn money? We think in the real world, like if you own a real estate asset, that's something that has value. You put money in and then maybe you can earn money back from having it. So with digital goods, that's very hard to do. Most of the time it's a one-way, you put money in and you don't get any value back. So just thinking about, what if you could earn upside because you're tweeting more and you're adding to the value of the network? Or if you watch Silicon Valley, the kind of file storage example gets used there a lot of, I have excess capacity of computing power, how can I contribute that to a network and actually use that as an asset that generates money or tokens back? So I think it's thinking about other ways that people can earn from what they care about and where they contribute, both their time and their money and their assets. So we're investors in Filecoin, IPFS. They are thinking about, doing the AWS on blockchain. So if you have excess capacity, you can contribute, you can earn money from that. And then if you're a developer looking for decentralized storage, you can take from that. So it's more peer-to-peer than a centralized system.
A project I'll highlight, which you can actually immediately download and play with this right now in real life. It's called Rise. It's an app. It's a live video streaming platform. It's very similar to the social media platform example I gave earlier. You go on Rise, you broadcast sort of a live activity, generate excitement and attention into the network, and you get rewarded in tokens. And then you can immediately, in the future actually, not immediately now, you can exchange those tokens for monetary value on an exchange. And so that's the idea of this, creating an intention economy. You don't have to do much more, to Brittany's point, than just to participate and generate sort of a positive good for this economy.
So one kind of theme that I'm hearing from these projects is we're bringing some of the stuff that we have currently offline, online, in a way that we couldn't before. And so given that these technologies are somewhat meant to subvert existing institutions, right? They were founded by people who call themselves cypherpunks, right? Like radical libertarians. And in order to gain popularity or use, what is the role of these companies or these projects to actually interact with these existing institutions? You know, should they stick to their ethos and ignore them and make this permissionless environment? Or do they have a responsibility or even a need to go out and meet with these existing stakeholders? And Wendy, I know you have some strong opinions about this.
I have some strong opinions about this that might not sort of agree with a lot of people's in this space, but I think the reality, the truth is probably a balance. I will just sort of talk in favor of integrating with existing institutions, because I think for some use cases like financial inclusion, as well as like, you know, this thing that we now talk about like stable coins, which is basically like a fiat-backed stable currency that you can use in crypto environments, that they're so linked to a government sort of monetary system, and that's sort of been refined over centuries, right? There's a lot that goes into monetary policy, and I think there's certainly a lot to be learned from projects that are building it from scratch and the experiments that they're running in real life, but I do think for the space to become ultimately as mass as, you know, the builders in it want it to be, there will need to be hooks into just real-world institutions so that people can start using it. For instance, like right now, it's still pretty hard to be a crypto user. There's very few sort of very user-friendly things you can do. I think for us to be fully connected to the regular financial institution, the crypto financial institutions will have to somehow hook into those. And you're already seeing sort of actually now centralized companies starting to think about how they incorporate crypto into their strategy. Robinhood launched crypto trading. I think those are really great steps from the centralized world out, but I do think we need to see more steps from the decentralized world in.
Yeah, and you've kind of seen existing projects, like you mentioned, Rise, which is off of the Props token, which was off of YouNow, which was a growing startup that already had, you know, millions of users. So they're thinking about how does decentralized change our business, but they're a little more maybe innovative than, you know, a traditional like Bank of America kind of. I don't think they're going to switch over to blockchain that quickly, but we are seeing a lot of examples where traditional equity-backed companies are now thinking about how blockchain or tokenization can matter in their ecosystems. Like Kik also has a token called Kin, and Telegram, you know, was a startup that's already there. They've done a giant ICO, as you guys probably have read about. So I think that it's not just for the big, old, stodgy companies. It's kind of these companies that are up and coming. I think we'll see more innovation there first in terms of enterprise adoption than just the big players.
And there's just to add a little bit to that, there is definitely that element of startups who are now encountering fierce competition from Google, Apple, Facebook, Amazon in the sort of traditional web markets, who are responding by trying to find other business models that Google, Apple, Facebook, Amazon are not going to replicate. And so YouNow is a great example of that, where YouNow grew for a long time, building what was at a time the largest live streaming video platform before YouTube Live came along, and then Facebook Live came along, and all of a sudden then the market became a lot more competitive. With Rise, they're able to find a business model where, because they've created their own programmable money, they're able to use their own programmable money to reward their users directly for their contributions to the network. And that is a very different business model from, say, the way Facebook operates, where every user of Facebook contributes their data to Facebook continually. And like Brittany said, none of it comes back. It all goes to Facebook and Facebook shareholders in the form of profit. With this business model, we're able to distribute the value that we all contribute to these platforms more evenly amongst the people who actually create the data that makes them valuable.
So given that blockchains can be like a defensibility for young companies, can be almost a new business model, and a new funding mechanism, actually, I want to do a straw poll. Who knows what an ICO is? Okay, good. So we have a pretty savvy audience. For the people who don't, it's an initial coin offering. It's one way to distribute those tokens that our panelists were talking about. And you know, there are a number of other strategies. The ICO market has sort of gone crazy in the past couple quarters. raising ungodly sums of money for these young companies. What do you guys think about that trend? I mean, should everyone do an ICO, or who is it right for? And what are some other novel token distribution models, given that you want to incentivize your early users?
Yeah, they're raising so much that they're probably godly sums of money.
Yeah, what was it, 535 billion has been put into project value or something?
Yeah, ICOs are an interesting phenomenon because they're, just briefly to describe what they are, it's basically you've come up with an idea for a crypto network, you've created a token that goes along with it, and it's scarce, and you've programmed it in such a way that it works for the network, and all of that is good. You can now raise money for your company instead of going to traditional venture capitalists and selling shares in your company. You can basically do something like a Kickstarter by selling these tokens out to the public, and so that's allowed for a lot of companies to raise a lot of money. Telegram raised
$1.7 billion.
$1.7 billion, and well, we probably shouldn't go there, but a lot of companies raised hundreds of millions of dollars and then billions of dollars by doing these public sales, which are kind of similar to an IPO in a traditional company. Now, the original purpose of the ICO, when the market came up with the idea, it was to accomplish two things at the same time. One, raise money to finance the early development of the network and the company, and two, to set a market and a market price for the token from the start. Meaning when you sell these tokens to the public, now you've deployed them, or a lot of people now hold them, and because you can trade these things on exchanges around the world, now there can be a market price for those tokens. And the reason that's important is because each one of these networks has some kind of financial incentive mechanism where the people who do the work or contribute to the network, say on Rise, if you're live streaming, you're earning these tokens. These tokens are worth something because there's a market out there of people buying and selling them. If you do an ICO, you've kind of bootstrapped that market such that when the network eventually launches, if you earn that token, you can immediately sell it for actual money. And so that is a very pure and sort of clean and elegant way to kill two birds in one stone. But what happened is, as enthusiasm around the blockchain space picked up, particularly last year, we overfunded a lot of these companies, and people overinvested in these teams, and as a result, it caused the whole market to go kind of crazy, and attracted the attention of regulators like the SEC, who now really don't like these ICOs because it induced a lot of volatility, and a lot of people lost money on them. And so now I think the market has turned a bit. ICOs are less interesting and less exciting, and people are kind of scared of them, especially now that governments are looking into it. And so we're seeing more and more companies not do that and approach other different models. I'm curious about what you have seen and what you're interested in.
Yeah, I mean, now just to re-ask Nat's question, how many of you have invested in an ICO? Okay, much fewer. So I think an ICO it's interesting because it's about fundraising, but it's also about early community building, right? You want to get people on board early that can help your network. And I think the general assumption was anyone who has money in the game or skin in the game is going to be helpful in your early days of community building. I don't think that assumption has panned out to be true across the board. I think at an early stage, the project, it's sort of so important who is involved at that stage, what skill sets they have, what future value can they add to the network, and beyond sort of financial value, but community building value, and what are sort of like viral things that they can do to help grow the network. And arguably, I don't think most ICOs, the way that they were done, selects positively for the best early adopters. But there's certainly exceptions depending on sort of the use case of the network. And so I think some more interesting distribution mechanisms we'll see in the future are ones that are more selective about who is a part of that first phase of the network. Because arguably Snapchat, had it launched in sort of Midwest Michigan, where I grew up, and been picked up by like not cool teenagers versus like LA cool hip teenagers, it wouldn't have done so well. And I think the same kind of philosophy applies to the early sort of adopters of crypto networks. And I think you'll start to see more selective processes. Looking for, if it's a data science network, looking for data scientists who are eager and also can participate to be a part of that early either fundraising or token distribution round. And other models like that.
Yeah, I think what's interesting as well about it is that these tokens that are being raised, it's not like traditional equity where there's a CEO and CFO and they're kind of managing shares and they're communicating publicly and they're reporting and doing all these things. Most of the token sales, or some of the big ones, they're actually raising the capital into a foundation that will be decentralized. So that means that there's no single boss. The community gets to vote with how things get done. So I think that concept of there's really not going to be a ton of control long term once these networks get adopted is interesting versus it just being a single company that's raising a lot of money. So we've seen a lot more popularity of a company is raising equity and then they may issue a token through a foundation, and the economics of how those two have a relationship is kind of a question mark, and it's being iterated on a bunch. So the funding mechanism, like if you're in finance or law or accounting, like you should be in blockchain because there's so many hard questions that most projects don't have answers to, and I think it'll be very iterative to see how that funding plays out. So there's no shortage of funding, like ways that you can fund your early project, but I think what the winning model will look like is kind of, it's too early to tell because how that value accumulates and how that will actually lead to a big, stable project, we don't know. I don't know. Maybe you guys have thoughts.
No idea.
And just to add on to that, a little bit besides the point we're talking about right now, but ties to an earlier point, if you're in sociology and economics, behavioral economics, psychology, behavioral finance, like we need so many more people from these thoughts, schools of thoughts in the space to design these networks. And I think those are really important people to get early on board with ICOs, going back to what we were talking about.
So, I mean, both of you guys said you don't know how to tell and value if these are going to be big or important networks, but this is your job, is to invest in these things and make those predictions. Like, how do you do that? And you know, like these guys can't give real advice to you guys. They're not going to recommend any ICOs. But what's your process like? What do you look for in teams? What are red flags? And like, how do you tease out the intrinsic value of these projects versus maybe that their tokens are going crazy on the secondary market and, you know, it's all speculation?
And so there's two sides to that too, or two ways to approach that question. The first is a little bit more on the art side of venture capital, because venture capital is a bit of a mix between art and science, and the art side is definitely the more speculative side of the work, which is we work based on, we develop a thesis around what we think the future is going to look like, and then we invest in teams that are going out and are building that future. And so when you're making an early stage investment in a company that's building one of these networks, the thing that you want to focus the most on is the quality of the team, their ability to execute, their ability to get something to market, and we'll figure out what it's worth later. Yes, there is the science part of trying to figure out, okay, what are the terms of the deal, how much money to invest, what you get in return, and so on. But really, when you're investing this early, you're making a bet on a version of the future that you think is going to be very, very valuable. And it's pretty hard to predict how that value is going to play out. That's not unique to this space. It's the nature of technological innovation in general. When Twitter was starting out, we worked at USV. They were one of the first investors in Twitter. And it was pretty hard to figure out, okay, what is Twitter going to be worth in the future? But you had a lot of people coming to this network, using it, and engaging with it, and loving it. And that was a good bet to make for that reason, because they could see society changing around the emergence of social media. I think the three of us and many others are seeing that same kind of change in society around crypto, where we're seeing more and more people buy into this idea that these networks allow us to distribute value more broadly amongst the people who participate in the online networks that we participate in. And that feels inevitable and feels important and feels like bigger than anything we've had in the world. And so we do spend a lot of time trying to figure out how to value these things, how to develop conviction in these things. It's a little bit like when actually it took a while for us to understand how to value equity in companies. It took a while for us to develop the valuation models that we use now that are taught in business schools. There was a time where we didn't have those tools, and it took decades and decades and decades of investing in building companies to understand, okay, you have to look at cash flows, and you have to look at, how do you multiply that? How do public markets treat these things differently? We're going through that same process, except that we're only 10 years in. Bitcoin was released or announced in 2008, so we're just about 10 years in, and we just haven't been around for long enough to really understand what the value drivers are to say, okay, I can tell you exactly how much this token is going to be worth in 7 years. But it's really more a bet on the future of society.
Yeah, that's a pretty big and positive bet I'm willing to make. And just on that, I think there's a little bit of a traditional venture wisdom here. I can't remember who I was talking to this about this, but I think it's not, in my opinion, not really a venture investor's job to have a clear, very clear idea of the what and the why, but more to be able to find patterns in the how and the who. And so you start to look for entrepreneurs that have the same kinds of skill set you've seen build in other businesses in the past. And arguably there's some skill differences here in a crypto entrepreneur versus a centralized startup entrepreneur. One is much much more faster moving SWAT team centralized, sort of needs to scale him or herself really quickly, and then the other is more about community building. But I think there's definitely a lot of characteristics that are similar between the two categories of entrepreneurs. And then the how, I think, very simple process for me, and maybe I'm oversimplifying it a little bit. I just ask teams that are building really solid projects, what do you need to use right now to get to where the next phase of your project is. I think there's a lot of big critical gaps that still exist in the ecosystem, without which it would be very hard to build a functioning product that the end user can appreciate. And so people who are filling in those gaps or trying to fill in those gaps, I think that's where I'm spending a lot of my time looking. And then last, there's really interesting how trends of just people becoming enamored with one thing. Have you guys heard of CryptoKitties? How many of you have heard of CryptoKitties? and that's a lot, right? I think,
What is CryptoKitties for the people who don't know?
CryptoKitties are these digitally scarce collectible cats, literally CryptoKitties, that have sort of different characteristics that make them more rare, different generations, different features, and people just collect them. It's a little bit like a game, kind of like Neopets. I don't know if anybody...
Pokemon cards?
Kind of like Pokemon cards. Dogs. Digital, versions of those. But that was a trend that happened really quickly. People became enamored with this thing. And I think, savvy venture investors, picked that out right away without having to exactly understand the why right this moment, but then develop a thesis about it sort of later on.
And it sounds like a trivial example, right? Like Pokemon cards, Pogs, fads and stuff, but these are often the vanguards of new technologies, as things that people initially think are toys. And honestly, Pokemon cards doesn't work in a centralized online world because the person who's issuing it to you could just 2 days later say, actually there's 10,000, right? There's one in the world, and then they just go into their database and change the amount of them. So it is sort of an illustrative point to this digital scarcity that we keep coming back to.
Just one thing I want to add around the investing thing, I think what was said here, absolutely, how do you value these things? I think the one thing to note, though, as of today, there's so much scammy, spammy crypto stuff happening. So your kind of red flags question, there's a lot that we sift through that is just complete scam, Ponzi scheme, no tech, vaporware. So all of that exists in this ecosystem as well. So I think a lot of the investor bets, maybe out of the, maybe 20% of the projects have a legitimate way that they could potentially move forward. And out of those, you then go down to the regulatory and the legal and compliance and how are they thinking about setting this up. Because if it's two engineers and they're just going to go launch an ICO and they haven't talked to a legal team or they haven't considered the tax implications of these raises, all of that will not be successful as a project either. So we kind of have to chop off like a lot of the stuff that we're seeing just to get to the like, okay, these people may actually be legitimate and actually have potential and have the team and have the vision to kind of get there. So it is kind of a lot of fun, but there's also so much noise. And if you read articles, there's constantly complaints of like how terrible a lot of the things are. So I think mining through all of that as an investor to find things that are actually viable in any way is a big part of the job if you're in this space right now.
We should probably leave you with something at least to think about in terms of how value works in this space. And even though I don't think anyone is quite sure how to precisely define value, what we do know is how it's different from the traditional world. And so we know how to value a company, and we value the equity, the shares in a company based on how profitable that company is or how profitable we think it's going to be in the future. And that is a much more understood, you produce a good or service, it costs you this, it costs you $5 to make it, you sell it for 10, that's your margin is 5, you sell 10,000 of those, you made $50,000 in profit, and you can kind of do that math all the way down. Here it doesn't work quite that way because you have these networks with these assets, these tokens that are scarce, and rather than a token being a right to a revenue stream. So if you think about if you own 10% of a company like Twitter, what you really own is the right to 10% of Twitter's profits. Here, the token is not an asset in quite that way, but rather it appreciates in value as more people come to use the service and come to use the network. Why? Because each token or each of these networks defines a limit on how many tokens there are, and each of these networks, or most of these networks, require either you need to either spend the token or have the token in order to use the service. So imagine that you have to have some Facebook or Instagram tokens to use that service. Then with every new user that signs up to the service or that starts using it, they are buying these tokens and they're holding these tokens in order to use it. So what that means is that the value of these things tends to, or it should track basically how many users are coming to the network, as opposed to how many profits a company may be able to extract from them.
Yeah, but just the one challenge to that is I don't know if long-term the tokens will actually accumulate like a lot of value, kind of in the way that we look at web services. Like AWS, their price is actually driving down. So like if you had AWS tokens, because they've increased the size of their network, they actually have a lot of volume. So the market cap of like an AWS, because it has high volume, is there, but like the actual unit in which that you're paying, it may go down. So a lot of projects are like, oh, and then we just assume that the token goes up in price forever. Not even thinking about the external crypto community, like when we have crashes like now with Bitcoin and Ethereum, that's driving down prices across the network. Even if the utility is really high and the token is very valuable in an ecosystem, you can't leave out all the economic factors that kind of influence the price. So if there's a big crash in Bitcoin, maybe that shoots up the price of your token, or that may sink it, even if your network is wonderful and you have all the users in the world. So
very, very true.
Yeah.
So don't just assume it goes up.
Yeah, I think very important here to separate the supply and demand curves for the service or the good on the network, and then for the token itself. I think there's very different ways to think about those. For the token itself, there's a lot of psychology at play, collective belief that the token will go up in value, therefore making it scarce, making people hold it. I think that school of thought is still very much sort of unexplored, as far as I know.
So there's a lot of scams out there, clearly. And the SEC is just starting to sort of get into gear with enforcing some of the most egregious ones. But these projects are permissionless, right? They're global, they are around the world, anyone can be involved. So the United States stands a lot to lose, at least in my opinion, if they take the wrong regulatory stance, right? Because these people you can move to Switzerland, right? There's the crypto valley is in Switzerland. You can go to Puerto Rico now, Malta, Gibraltar, Singapore. All places which may have a lighter regulatory touch. Do you guys have an opinion there? Or do you think the SEC is doing right now? Do you think there should be safe harbor?
It's tough. It's a tough job for the SEC because their job is to protect investors, and the reality is that most people are losing money on these things because there's a lot of unsavory actors who, as we've talked about, there's a lot of scams, a lot of people who promise a lot of flashy things and then get people to invest and then run with the ICO money and so on. And the other interesting thing is that this is probably, or at least to my knowledge, the first time that the SEC is now in charge of innovation, or at least has the ability to either halt technological innovation or allow it to move forward. And so we do have to appreciate that they're in a tough spot, because they are right. But we are also right in that if we overregulate, there's no way to shut this thing down, and this new model is inevitable. And we're already seeing the effects of the SEC's potential hand in the space affecting the market in the United States. There's more and more companies who are not accepting investors from the United States or customers from the United States out of fear that the SEC will go out of them, legitimate projects. And that can spiral out of control if there isn't sensible regulation to be built around. There's a lot of ideas like a safe harbor and so on, though the challenge is that it'll take a long time to really create a policy framework that works. But it is good that there is an element of jurisdictional competition where, at the very least, we do know that it's not going to die by the hands of the SEC.
Yeah, and I think what the misnomer is too about like regulation in Europe and other places is they're looking to attract talent, not just to be an easy place, but many countries that are being very friendly to ICOs have huge tax burdens on those ICOs because they want the tax revenue. So sometimes it's not just the SEC that you have to think about, like the IRS, like they're a player in this, FINRA, how you trade. I think there's a lot of regulation that happens, and the U.S. Has a lot of stated regulation. I think they're trying to work with people. They're constantly talking to investors and innovators in the space. They don't want to halt things. But as Joel kind of pointed to, like the SEC has no motivation to be progressive of innovation. They are like protecting the downside. Like that is their job. So I think it may be a while until they come out and say like, hey, we want to help people do ICOs. Instead, I think they'd rather say, we're going to come after you if you do an ICO. Just have your books in order. Do the right thing, do the best that you can. So we advise projects just be as conservative as possible in the legal, accounting, and documentation. That way, if regulation changes, they come knocking on your door, you're prepared up to the extent of what we know at the time that you did it. Otherwise, there's no way to move forward unless you kind of take that like conservative but progressive approach.
And this is a case that really well sort of illustrates your earlier point around crypto integrating into existing systems. I think as investors always urge projects to self-regulate, and I think when you do that and you're proactively working with regulators, I think the stance becomes a lot less harsh versus where there's a lot of speculative greed and sort of obvious regulatory arbitrage. It's I think risky to go that route.
So I think we have time for one or two more questions. I'm looking at my timekeeper over there. We have 10 minutes. Okay. I wasn't going to take audience questions, but do you guys want to? Like, sure. I don't know. It might be fun, right?
Hi, thanks for taking questions on this. Usage, you mentioned, Joel, I think is a key factor. I think you all agree is a big deal with cryptos. How does an investor, how a normal person like us, figure out usage of a crypto?
I think we're still trying to figure it out too, so like we'll let you know. But I think that tangential to actually building on blockchain, there's an exciting opportunity for entrepreneurs to think about the tools that are necessary in order to support this ecosystem. We've seen some early projects, entrepreneurs, they're not building on the blockchain, but they're building reporting systems on the blockchain, or there's trading tools being developed inside some of these funds to just consider like, how do you measure usage? The good news is that this is a public ledger. So if you have kind of the basic understanding, you'll be able to scrape that information and see volume and adoption and
Well, there's actually, for most of these things, there's things called block explorers. So people have built websites that connect to the underlying blockchains of these networks and surface all of this transaction information. And so, as Brittany pointed out, the way blockchains work, you can see every transaction, and so you can actually look into Bitcoin's blockchain and see transaction volume over time, and then you can use that as a factor in your investment decision.
Are there sites that report on this?
Yes.
Yeah.
Yeah.
So typically each network will build a kind of explorer or interface for you to actually inspect the underlying data in the network. So it's pretty easy to, if you pick any random network, say Ethereum, and you type in Google Ethereum Block Explorer, you'll see dozens of different websites that have built a suite of tools, and you'll see charts and historical and all of that. So
sorry, let's move on to another question. Thank you though. We
Good
appreciate
question.
it.
Hey guys, so given that the three of you are all in venture, I'm sort of curious to see what your view is on the future of venture, given that ICOs are kind of taking off. They're slowing down a little bit now, but do you see ICOs disrupting VC, or do you see the value add that VCs have as something that's sustainable over the long term?
I think the question, will crowdfunding completely disrupt VCs, comes up every sort of cycle, especially during the phases where capital is especially plentiful. In this case, there is definitely, a more fundamental difference here in that crowdfunding with tokens, but it is still very early, risky, early stage investing for the crowd. And I think, over time, especially with capital availability fluctuating, you'll see sort of that being less prominent is my hypothesis, because it is sort of very early stage risk that investors are taking.
Yeah. Hopefully it'll, democratize VC. And I think some of the traditional VC models that you hold something for 10 years because you wait from early stage to IPO, that's going away if you have a liquidity event within 2 or 3 years. So I think VC will change internally, and I think there will be more competing models of how you raise capital, which is a good thing for everyone. And as VCs, we love innovation, and if our own industry is not innovating, that's a big problem. So I hope it does change.
Thanks for coming today. This question was, so Brittany mentioned how the funding is going into a foundation, and I just kind of wanted to know a little bit more about what does the framework look like around a foundation versus a traditional equity funded startup, and regulatory, and how are they held accountable, more or less, or is that just a semantics difference?
Yeah, I don't know if there's a one size kind of fits all, and that's what. If you're looking at projects in the space, you really have to dig into who owns this token and where are the economics going to sit, and how are there incentives for the teams to continue to build. Because that relationship, if there is a foundation, it's usually a nonprofit. The belief is that it will outlive the building entity. That may be set up in a foreign country. It may be, have some tax provisions. There's all sorts of components, but I don't know if you guys have seen, but most of the ones we've looked at, every project is kind of setting them up differently, I think to their own benefit. The challenge becomes when the economic incentives are not aligned, that maybe the token is accruing all the value to the team and not the foundation, but the foundation is the thing that's going to outlive everything else. So you just want to be careful of how much ownership's there, who owns what. So I don't know, I feel like there's more questions, but maybe you guys have thoughts.
Yeah, it's definitely evolving. We're also starting to see hybrids between companies and foundations. So teams will set up a company and a foundation to make the distinction more clear and add a little bit more structure. It's definitely fluid. Not all of the foundations are set up for honest reasons. So some people just do it for the tax savings and so on. But many of them do it for legitimate control issues to make sure that the right message is sent to the community that this isn't a for-profit company that's going to eventually come back and take profits out of the system. And so I think the answer is both practical and philosophical. It feels different to deal with a foundation than it is to deal with a company.
In the back over there? Yeah.
Hi, thanks for coming. My question is, have you seen projects that use the blockchain to store and protect digital identities? And if you have, how do you think such an application or a network would create value?
Oh, this is my favorite topic right now. I'm jumping at the chance to answer this. I've seen lots of projects going at it with identity as its core value proposition, and I'm not sure if that's sort of the one that's going to win the game. I think identity, when pitched to the consumer, is much more powerful when you're selling something else interesting, like social media, for instance. where they can get a lot of value out of the ecosystem outside of just having an identity, or it can be mandated by like a government or a bank like KYC. But I think the consumer use case is really interesting because you can sell someone, some media use case or a gimmicky, even collectible use case, and then have them put all of their data into this system, and that becomes a digital identity for the person. Is kind of the way I would rather see it evolve. The other way is you can probably see governments mandating some sort of blockchain-based identity system, and it's already starting to happen in some governments, but I'm of the personal belief that identity is absolutely necessary for governance to develop in this ecosystem, for some of the voting issues that we're seeing in networks to be completely fixed. I think we need identity. I'm not in the majority, I think, in this belief. But I think, yeah, I wish I could see more projects not sort of solving identity for identity's sake.
All right, last question in the middle here. Go ahead.
Hi. My question for each of you guys is, what do you see as the biggest bottleneck or barrier to the adoption of like user-facing application built on blockchain? And then with that, what's like the most exciting technological innovation or problem that's being worked on in this space that might help usher in adoption over the next 12 months?
I think one of the big bottlenecks is talent. These projects have raised billions of dollars, and there's not enough people around the table who can actually deliver on the vision. So I think that bottleneck, it's going to take time just for people to learn and get excited and switch over to this space. And that's not just developer talent. Obviously, that's a huge key. But even thinking about community and economics and philosophy and all of these different things, I think
regulatory policy,
regulatory, legal, all of those pieces are critical to actually get these projects something that's shipped in the marketplace. Because right now, there's very few protocols that are actually live that you can build on. I think that's a problem.
But just on the flip side of that, this is the fastest inflow of talent into any sector like I've seen. So it's still very promising. I think it just needs to be faster.
Thanks. Well, I'd like to personally thank the panelists for coming, and let's give them a really warm round of applause. Thanks, guys.
Thank you guys.